Hello and welcome to episode 326 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
I'm great, Andy. It's you that I'm concerned about, because at one point this week I thought I was going to be flying solo on the podcast, because if people remember last week, Andy didn't sound very well, and actually you can't hear it, but he's just muted his microphone. He's just started to cough uncontrollably, but poor old Andy had a terrible time of cough and everything. It wasn't COVID, I just pointed that out, but you've got, I think, a chest infection or something, Andy. But Andy he's not the kind of guy to take a day off sick, and even Andy was forced to have a couple of days off from Money to the Masses. So I thought I'd be doing this podcast on my own this week. So I'm just happy that you've returned as my week, as what do you call it, a co-pilot?
Co-pilot, yeah, well, kind of, yeah, co-presenter.
Co-presenter, do you know what it is though? It's because of the red arrow thing you were telling me about.
That's coming up later, yeah. We've got the red arrows that are going to be flying over my head and doing a bit of a display in a minute, and we're recording this on a Friday, and where I live there's a big air display, so we may catch it on the podcast this week. That's very kind words you said to me earlier. Yeah, you're right, I don't like to take time off. In fact, I was looking back through the records, I'm pretty sure that's the first day I've had off sick for about 8 or 9 years. So someone will have heard a previous podcast where I said I had a day off sick and proved me wrong, I'm sure, but I think that's about right. Anyway, it's nice to be back, and I'm looking forward to what's coming up on the podcast this week and just getting back into it. What have we got coming up?
Yeah, before I tell you what's on the podcast, Andy, a couple of things I just wanted to mention to people. They may have noticed, podcast listeners, I do talk about the posts that relate to each podcast episode that we put onto the website, so moneytothemasses.com. So you can find a article where there is an embedded player for each episode, and we put the resources or the things we might talk about or links in those posts. But this week I've started to create abridged versions of transcripts for each podcast. Now, it's something that we've been getting feedback on, various different things to do with Money to the Masses. We sent out a survey to our newsletter subscribers. So if you don't have our newsletter or you don't subscribe to it, make sure you do. Go onto the Money to the Masses website and you will see how you can do that. It's moneytothemasses.com/newsletters is the URL. And the result of that survey suggested things that people would like. And one of them was a change to the way your newsletter looks. We've started to change that, where there are a sense of priority in the articles that are in that newsletter. So things that I think are most important for you to read about this week. And I say transcripts are one of the things that came from that. It basically, some people don't listen to podcasts, but they obviously like to read instead. So we're trying to create abridged versions of the transcripts. So we'll see how that goes going forward. Please do go and look at them and do give your feedback, because I want people's feedback if they find them useful. And also, we're now doing deals. So Jordan Cox, many of you will know Jordan Cox, who's a friend of Money to the Masses and this show, and he is now doing deals for Money to the Masses. We're putting them in the newsletter. There'll be new posts, articles on the website, which I will tell you more about in the future, and you can find if you go on the Money to the Masses website. So there's some positive changes for people listening to this podcast, which I think they will enjoy. And there may be the possibility that we may get Jordan on the podcast from time to time to do some deals, or maybe even another show. So again, any feedback people have on that idea, then that would be welcome. So moving on, what's on this week's show? There are 3 bits as usual. One thing I want to talk about is stress testing your portfolio, but more importantly, how assets behave in stressed market conditions. So when equity markets are struggling, so how you find havens during those periods. And it's off the back of some research that I've done for 80/20 investor members. I also want to talk about beach huts. So in recent months, I've even popped down to the beach, and I know many listeners will have done so, try and have a day out with the kids. And of course, we can't go on holiday as easily abroad as we did previously because of the pandemic and the restrictions. And one of the things that has become increasingly popular are beach huts. So I want to do a piece on beach huts about the cheapest places to go and find beach huts to use, to rent them, the most expensive places, and also to look at them as an investment. So how much does it cost to have a beach hut? There's probably lots of people who sat there, looked at beach huts at the seaside like I've done this year, and wonder how much do they cost and whether they are actually a good investment. And the final piece, Andy, is going to be you
So I'm going to do a really short piece on school uniforms. It's a hot topic at the moment with children due to change schools in the coming months, and they're getting more and more expensive. The average cost of school uniforms is something crazy like £300. And I'm going to reveal a way in which some people might be able to get a grant and actually be able to save money on getting those school uniforms, and a few tips and tricks on that. So should we start with the investment piece?
Okay, so what I wanted to talk about this week regarding investing is the idea of what happens when equity markets have stressed conditions. So when I talk about stressed conditions, I'm talking about typically scenarios whereby the equity markets have fallen by around 10% or more. So there's been a correction of some kind. Now, there's been numerous instances in recent history where that's happened. And what I've done is gone back and looked at some of the more significant ones and then looked at how assets have performed during those periods to give some insight to people. Because there's a lot of conventional wisdoms about what happens to assets, which ones do well when equity markets sell off. And I actually wanted to look at it and give some hard facts and figures for people who listen to this podcast. Now, for 80/20 investor members, what I have created, and this is a tool that's been around for a number of years and I continually update, is something called a stress test tool. Now, if you think about what happens maybe in the banking world, that you will have banks stress tested. So what would happen in certain conditions, economic conditions? Could they survive? Would they collapse? And what I did is create a tool that does something kind of similar, but for investment portfolios. So if you imagine you've got an investment portfolio, if we had a replay of the pandemic, or we had a depression, or if we had the central bank starting to raise interest rates, how would your portfolio react? And that's quite a difficult question to answer because the event hasn't happened. So these are like black swan events that could happen, but they're probably a bit more like grey swans because they're things we have seen and we've had experience in the past. And that's where stress testing can come in, and you can do it on your own portfolio. So if you look at past examples or past periods in market history, so stressed periods, you could look at how investments or funds have performed in those periods to gain insights into how your own portfolio might potentially work. So it helps answer that question that I'm often asked, which is what will happen if the market crashes 10%? What happens if we pull back from all-time highs? Now, I don't have a crystal ball, but we can look at what's happened in history as a steer. Yeah, of course, past performance is not a guide to future returns, but it's the best thing that we've got to try and make a judgment. So what I did, I created a tool where there are 5 scenarios that have been stress tested. And as time goes by, sometimes I take some of those scenarios off. Brexit was one of them. So when we had the Brexit vote, the referendum, the markets reacted aggressively. They repriced during that period. And what that period around that referendum showed us is what could happen if we had a hard Brexit, because the market suddenly tried to price in that prospect and markets moved very aggressively in a very short space of time. So if you take a period of time where there's been a lot of stress in the market, there's been an element of repricing, then you can use that to gain insight to what could happen if that trend was to continue or reappear or escalate. So if we'd had a hard Brexit, what happened in the days after that referendum, and then the market started to calm down after that initial reaction, what happened in that initial aftermath could be used to determine or give insight what could happen if we had a real hard Brexit. So the 5 scenarios in the tool that I've created for 80/20 investor members as it stands go back as far as 2018. So back in 2018, one of the stress scenarios where we saw equity markets fall globally by at least 10% across the board was we had a spike in volatility and we had a bond market wobble. And there was a bit of a panic over rising inflation, which sent bond yields flying higher, and which, of course, if bond yields rally, it means you get bond markets crash. And because it was a crash in bond markets, it spooked equity investors. So it provides information that can be used as a stress test if we see something similar. So that was January 2018. In late 2018, then global stock markets became rattled when the US Federal Reserve was intent on tightening monetary policy, so raising interest rates. And then there was the prospect of unwinding QE. And that caused one of the worst December slumps on record. And the market was only saved when the Fed began loosening monetary policy again. So it gives us very good insight into how markets and assets might behave, but how individual funds might behave. So the stress test tool that I made for 80/20 investor members analyzes over 2,000 unit trusts and how they behaved during these 5 stress tests. So you could go and rebuild your portfolio, put it in the tool, and you could see, well, this is how it performed during those scenarios. So this might be able to give me some information about how it would perform if markets fell 10%, equity markets fell 10%, or how it would perform in a particular scenario. So the other 3 scenarios were an escalation in the trade war, so tensions between US and China. The real focal point of that was May 2019. Then, of course, we had the fastest bear market in history. So the pandemic came along in 2020, and we saw most major stock markets fall 30 to 40%. And the fear of a depression following the recessions that we saw globally really spooked markets. So that is a good stress test of what might happen if we get a depression, so how different funds and assets might behave. And the final one, which I've introduced this week, is the reflation trade. So we've seen in recent months the reflation trade where certain assets have done particularly well, which are things like financials and value stocks and cyclicals. Growth stocks like tech stocks had performed badly. We saw a little bit of, obviously, in the last week or so, if you've been listening to Damien's midweek markets, a bit of a reversal of that. So tech stocks started to do quite well. But the idea that we would have strong economic growth with loose monetary policy, with the central banks not doing anything to dampen inflation or unwind QE. So that's quite a different scenario to the others. But what you could get is, if they did start to tighten monetary policy, then that would reflect the Fed tightening scenario I mentioned earlier on. Or if bond markets started to collapse because yield spiked, then you'd have the volatility spike bond wobble scenario that I mentioned earlier on. So that's how you can stress test your portfolios. Anybody could do this. Go and find periods of time where you've had markets under stress. Pick the start and end date. In most of these scenarios, it's normally a matter of weeks. Sometimes it can be months. And then look at how everything behaved within your portfolio or funds you might like to invest in during those periods. You might gain some insight. So those are the different scenarios, and they're all still relevant at the moment. Now, I can't tell you how every fund performed in different scenarios. That's what the tool's for, and that's why people would subscribe, or one of the reasons they might subscribe to 80/20 Investor. But what I did, which I can share with podcast listeners, is I looked at a higher level rather than at individual funds, but how sectors performed during those different stress tests. And that means, so how did UK equities perform? How did North American equities perform? How did high yield bonds perform? And so I looked at how they all performed during different stressed scenarios, where the common denominator is usually that equity markets fell by about 10%. The exception is the last scenario, where it was really tech stocks that had the wobble. Other markets held up. But I looked at all of those different sectors or assets to see how they performed across the board. And so what I can share with people are the findings of that. So if we looked at the 5 scenarios, and I produced a heat map where the assets that performed the worst were in really dark red, and the ones that performed the best were in green. Now, obviously, we're talking about scenarios where the common denominator is that markets tumbled, equity markets I'm talking about. So if you looked at the table, in each scenario, the worst performing assets were equity assets. That's obvious. The ones that outperformed, and in some cases, very rare cases in fact, made money, were things that were more focused on bonds, alternative assets, and even currencies, which I will come on to. So, of course, if you look back at 2020, things like UK gilts done very well. And gilts are a thing that you'll see comes up in a lot of research that I've done. They can be very good diversifiers for UK investors because they tend to behave differently to equity markets. When equity markets crash, UK gilts tend to perform quite well. They tend to hold up and often make money. But within the equity space, there are nuances with how assets behaved, and even within bonds there were different nuances in how they behaved across all 5 scenarios. Now, if you look at the scenarios, broadly speaking, the best assets made between 2 and 10% while equity markets were tumbling. The worst assets, which almost universally on all the scenarios were those that were smaller companies stocks. So European smaller companies, UK smaller companies, and North American smaller companies funds, they could fall as much as typically between 12 and 15%, but of course the pandemic, they fell by almost 40%. So the first takeaway for people out there, if you're thinking about, well, if I want a portfolio and you're wondering about risk assets, and a lot of people think, well, how do I build a portfolio? What do I start with? What's low risk? What's high risk? This is starting to give you some insight. So when equity markets wobble and they start to fall, the funds that tend to perform the worst in those scenarios are North American smaller companies, UK smaller companies, and European smaller companies. Now, when we go up to the next level, that's when you start to get some surprises, because given that we're talking about emerging market funds, we're talking about Asian equities, Japanese equities, all these different types of assets you could buy, the next worst performing sector is actually UK all companies. That means funds that invest in UK companies. So it'd be almost the equivalent from the fund world of something like the FTSE 100. So where you've got managers buying companies like that. Almost across the board, if you take an average across all scenarios, if you held on to UK all companies funds, so UK stocks, you were down around about 11%. So only just a bit better than those smaller companies funds that I mentioned. Now, that might come as a surprise to people, because they might be sitting there thinking, well, the tendency for UK investors is to want to hold UK stocks because it makes them feel safe. But actually, in a scenario where there is a lot of stress in markets and people are panicking, then holding UK stocks can actually be detrimental to your returns. So if you take one thing from this podcast, don't think that just holding UK shares will offer you any kind of better protection from a slump in global equity markets. Because if you look at each of those scenarios that I mentioned, 3 out of the 5, possibly you could argue 4 out of the 5, emanated from America, but they still had a big impact on UK all companies stocks. Now, if you move up the table, I've done a league table, so the best performing at the top by average. So I'm going across all 5 scenarios, average the returns they made in each scenario to work out a leaderboard. And so I've just told you the ones at the very bottom. The asset that's at the top is US dollars. Now, in times of panic, a haven asset is one where people will tend to pull their money out and buy. And US dollars are the haven asset of choice for a lot of institutional investors in particular, because it's like holding cash, but the dollar is seen as that global currency. And so you'll often see in times of panic, the dollar strengthen against the pound. So I've gone from the worst, I've just mentioned the best performing asset to hold during a crisis. If we go up from the UK all companies sector towards the bottom of the table, where you lose about 10.71% on average in a major sell-off. Tech stocks are next. So they are the things like the Facebooks of this world. They fall almost the same amount. So it's about 10.6% in each of these scenarios on average. Then it goes up to UK equity income funds. Equity income funds are slightly more defensive because they tend to buy into defensive sectors that pay good dividends. So it will be things that perhaps like pharmaceuticals, those kind of things that people will buy come what may, regardless of what's going on in the economy. So that's why income funds tend to be slightly better or perform slightly better in a stressed equity market environment. And of course, them going up the list, you've got China next. That's down around about 10% on average across these scenarios. Then European equities, North American equities. Then we get to global emerging markets, which might surprise people. And then up from there, you've got general global equity funds. Then you have Asian equities, Japanese equities. Now, that might surprise people that obviously you've got the global equity funds underperforming Asian equities there. And part of that reason could be down to the fact that global funds tend to be quasi North American equity funds. Some of them have up to like 3/4 exposure. They're typically about 60% to North American equities. So they will behave quite like North American equities anyway. So what can happen is that when the dollar is strengthening, that can be okay if you've got US assets. That can be obviously positive when you repatriate that value back into the UK. But when the dollar is strengthening against every other currency, including the Japanese yen, then that tends to be positive for the Japanese stock market because it's a bit of an exporters market. So it has a lot of exporters. So if the yen is weak against the dollar, it tends to be a tailwind for their stocks, which is why they've been pushed up the table a little bit more. Then keep going up the list, you start coming to the mixed shares funds, so those managed funds that have exposure to bonds and equities. I won't go through each of those in detail. Then above there, you then get to emerging market bonds. Interestingly, what comes next are targeted absolute return funds. But all of these bond funds and managed funds typically lose between 2 and 6%, even when equity markets tumble. So strategic bond funds are down around about 2.5%, even in an equity market sell-off. You think they do better. High yield bonds underperform normal corporate bonds, the lower risk corporate bonds. High yield because they have a closer tie to the fortunes of the stock market. So that is a pattern you will see time and time again. High yield bonds fall around about 5% when equity markets fall around about 10, 11% on average. So there is a lesson there for people. Don't think high yield bonds will protect you in a downdraft of equity markets. Then the next bit you come to are the assets where you actually can make money on average in each of these scenarios. When equity markets sell off, are UK gilts, which are up around about 0.75%. But then it's the currency. So the euro tends to strengthen on average about 3%. And then obviously I said in first place was the US dollar. But one asset I skipped was gold. Now, gold is actually the second best performing asset across all of those scenarios. Now, gold is that fear factor that really benefits it. It's one of those assets that people tend to buy when they're scared, when they think the world is about to end or things get a little bit hairy, they tend to buy gold. So that's why gold can be a bit of a diversifier in a portfolio. So hopefully people have listened to that part of the podcast and they've taken away the risk tiering for assets if they're trying to build a portfolio. They've also learned that currency can be a bit of a boost for you in a sell-off, but also just sticking to UK equities won't provide you any particular protection from the worst of an equity market sell-off. In fact, in some cases, it can make matters a little bit worse. The one scenario, which was the reflation trade, and it was when value started to outperform and when things like energy stocks outperformed. Actually, UK equities was the best performing asset class, but that is a particular quirk of that scenario where energy stocks, the FTSE 100 is full of them, and value stocks started to outperform. And of course, the UK doesn't have a lot of growth stocks in the FTSE 100. It tends to be things that are more value focused.
Okay, so moving on to beach huts, and I was surprised to hear this one come up in the podcast this week. This is definitely something a bit different to what we would normally do. And funnily enough, I was away a couple of weeks ago to see my folks who live down on the south coast, and we were wandering along the beach one day, eating an ice cream, socially distanced, of course, and we happened to look at the beach huts to the right, and it started a conversation with my mum and dad about, we were sort of saying, well, who buys, are they bought? Do you buy them? Do you rent them? How much are they? Is it a worthwhile investment? So you're going to tell me the answers, so I don't even have to look it up.
Yeah, so that's why I found this piece particularly interesting, because I had the same thought. So down the Kent coast, which is basically where me and Andy, and not far from me and Andy, when we would go to the beach of our respective families, there are quite a lot of beach huts, and I see them people doing them up, and I thought exactly the same as you and your family, Andy. So from my point of view, there was part of me who was like, well, how much do they cost to rent? So I'm going to answer that first before I get onto the idea of investing in beach huts. So money.co.uk did a quick bit of research, which I'm going to just rattle through, where they looked at the average cost of renting a beach hut for a day. And they looked at the most expensive places and the cheapest places in the UK. And so the cheapest places you can get them are, and I'm going to say all of these names incorrectly because my geography isn't necessarily the best, but the cheapest place you could get one was in Mablethorpe Beach, which is in Lincolnshire, and you could get it for as little as £40 a week. If you go down this top 10 list of cheapest beach huts, then looking at it, it typically is around about £120 to £130 a week. And the places are Dawlish Beach in Devon, Broadsands Beach in Devon, Dovercourt Beach in Essex, St Ives Bay, which is Cornwall, Porthgwydden Beach in Cornwall, Swanage Bay in Dorset, Packfield or Pakerfield Beach in Suffolk, Meadfoot Beach in Devon, and Monmouth Beach in Devon. So I have to say I've not heard of half of those. The most expensive places, where looking at it, the most expensive average rent for a week on a beach hut is £500, which I think is eye-watering. That's the average. They've actually got numbers up as high as £750, and that's Wells Beach in Norfolk. One of the beaches on here, the second most expensive beach, is one that you and I will go to occasionally, Andy. It's Herne Bay Beach. So the average cost is £466 to rent for a week, which is an enormous amount. Now, Mudderford Sandbank in Bournemouth, that's £430 a week. Then Tankerton Beach, which is another favourite of mine, which is where I've seen all the beach huts as well, £430 a week. So you can do the numbers if you want to work out roughly what it is a day, because you can hire some of these by the day, because I have looked into it personally. Then I won't go down them all, but then you've got a couple of other beaches in Sussex, South Strand in Sussex.
That's the Red Arrows.
That was brilliant. I heard it.
Sorry, as you were.
Only we can get the red arrows on the podcast. Such is the draw of the Money to the Masses podcast. And Walton-on-the-Naze Beach, I think that's how you say it, is £278 a week. So looking at those numbers, for people who are thinking about using them, they might sit there and think that's affordable. If not, maybe not. If they don't think it's affordable, they might be thinking, well, that's a pretty decent investment then. Can I make that amount of money a week from a wooden hut? Then maybe I should look into investing in one. Now, looking at the cost of these things, it's a real eye-opener. Now, the average cost of buying a beach hut can vary enormously, and they can be as little as £6,000 to £245,000. And in fact, there was a £330,000 beach hut that was sold in Mudderford in Dorset. And that is because the average that I mentioned before of 6k to perhaps 245, that would be an average cost for a beach hut. But beach huts in Mudderford have the ability for people to stay in overnight, and that pushes up the cost even more. And in the last year, the average price of a beach hut has gone up 41%, which is quite incredible, really. So it can seem like a good investment on the face of it, but they can be expensive. So if you want to look at where you would want to buy one, well, there's a list of the most sought after spots for beach huts, which I won't read out on the podcast because I'm conscious of time, but I will link to it in the show notes and on the website. But if you decided you could afford to buy a beach hut and you bought one and you paid that price, whatever it was, there are other costs you've got to bear in mind and factor in. You now know what people will pay to stay there for a week on average, but once you've paid for your beach hut, you're going to have to pay a one-off transfer fee, which will go to the local authority, which can be as little as £350 or as much as £17,000, depending on the local authority. And it can also depend on if the buyer is a local resident or if they actually are related to the person who had it previously or not, which seems completely odd. You will also have to pay something called a licence fee or a lease, and these can vary between £200 and £1,000 a year. And you will also likely have to pay business rates. So beach huts are a property and you would have to pay non-domestic rates, and that can be starting from around about £180 a year, but you may be able to claim small business rate relief. And the other thing to bear in mind is that you've got to have maintenance. Now, looking into it, it's suggested that you would need to at least repaint your beach hut every 3 years, because remember, this is a wooden structure right on the face of the beach that's being battered by wind and waves. So you can imagine that it's going to get a bit tired very quickly. So that you've got to factor into the cost of a beach hut when you're thinking of it from an investment perspective and an investment return. And the other thing, if somebody does pay to rent it, you've got to go and clean it after they've gone for the next person. So overall, when I've looked around at the topic, the view from owners of them are that these are things that you buy and keep in your family as something to use for yourself. Not necessarily you're going to make any money from at all. They are there for you and your family to use and enjoy, and people keep them in their family for years and years. And in fact, reading again around the topic, when they do come up for sale, they often get snapped up before they even go on the open market, as it were, because people get wind that somebody's trying to sell a beach hut and then they will go and buy it off them. So there you go, Andy. Beach huts, not the best investment, but perhaps a pretty decent holiday.
That's really interesting stuff. Like I say, I've always looked at those things and thought, how much do they cost? And the Muddyford one that you mentioned, Damien, that was interesting because we actually used to go to Muddyford as a child. We had a caravan just down the coast from there in a place called Milford-on-Sea, and we used to go to Muddyford. We noticed that people used to stay overnight in those ones. They're quite nice big ones, those ones.
So did you just think they were pulling a fast one and just like sleeping there illegally overnight?
Yeah, I didn't ever get it because you could see that there was set up for kind of like a more permanent sort of residence, if you like. And I just thought these guys are trying to save paying for a proper holiday, but seemingly not. I mean, what was that? Nearly £350,000 for one of those? Crazy money. Actually, while we're talking about money and stuff and big money, do these things need to be insured? I imagine there's some sort of insurance.
Yeah, actually, that's a good point. I didn't mention insurance. So, yeah, you will want insurance on a hut as well. So, in case the thing either burnt down or if you had anything stored in it. Not that many people do store much in a beach hut, to be honest. But looking at the numbers again, you've probably got to factor in at least £150 to £200 maybe a year on insurance. But of course, I mean, that varies massively. So you've got to, again, factor in insurances on your beach hut if you want to invest in one.
I suppose one of the things you can do as well is you can pull together a few friends. If you all like going to the coast, you could have it as a sort of a mini UK timeshare, couldn't you? And you'll pitch in together. And we've done that before with a caravan. You all pitch in and it's quite nice. You'll get a little holiday away. Okay, so bringing it back from holidays then and thinking about school and school life. We mentioned at the start of the podcast about school uniforms. And so I'm just going to quickly go through a piece that Bronte wrote for the site. And it talks about how people can access a grant of up to £150 that can help towards the cost of school uniforms. So I'll quickly run through the details. And so I suppose the first thing to mention is this is actually a grant that's available. And by grant, that means it doesn't need to be paid back. It's not a loan. If you qualify for the grant, then that is it. You have to fill in some paperwork online and you'll get the money through. And then that can be used towards the school uniform. You never have to pay that back. Now, who is it that qualifies for these school uniform grants? Well, it's a little bit complicated, but the easiest way to try and understand how it will work is people who are eligible for these grants are the same people who may be eligible for things like the free school meals. So I'll run you through who those are. It's people who receive income-based job seekers allowance, income-related employment and support allowance, the guaranteed element of pension credit, child tax credit, universal credit, working tax credit run on. Any one of those things could mean that you could be eligible. So if you tick one of those boxes, then there's a potential that you could qualify for this school uniform grant. Now, it's different right across the UK. England, Scotland, Wales, Northern Ireland, they all have slightly different grants available. And actually, they're all called something slightly different, which does make it a bit confusing. If we focus first on England, now only 12 of the 51 regions in England actually offer this grant. So it's not a compulsory thing. It is a voluntary thing that each individual council can offer as a potential grant. And actually the money that you can receive varies wildly right across England as well. So for example, in central London, some of the boroughs offer up to £150, whereas if you go up to, say, Lincolnshire, then the maximum you could receive is around £20 to £30. So again, it wildly varies. It depends on the region you're in. The best thing to do is to go to gov.uk/help-school-clothing-costs. I'll do that again. It's gov.uk/help-school-clothing-costs. What you can then do is put your postcode into the postcode checker and it will tell you what you're potentially eligible for. Again, there's eligibility criteria based on income, savings and other bits and pieces, but just have a look and see if you're eligible for that. Again, it's different for the other regions in the UK. So Scotland, Wales, Northern Ireland, it's a slightly different address. Rather than read those out on the podcast, that will be rather tedious. We will put that on the podcast notes for you to take a look at.
Great. So that's it. We're done, aren't we, for this week, Andy?
We are. If you want to get in touch with Damien, you can do so in the usual way. It's Damien@moneytothemasses.com. Twitter, it's @moneytothemasses with a number 2. Don't forget we're on Instagram and YouTube and all the usual places. Get involved with the Facebook group if you can. It's facebook.com/groups/Money to the Masses. Oh, and do review the podcast if you can on your podcast app of choice. Next week, we'll be reading out some absolutely cracking reviews we've seen coming through. So that's it. Until next time.
Until next time.